Welcome, everybody. I'm your host, and today we're tearing down the red herring prospectus of what is arguably one of the most anticipated listings in the entire Indian healthcare sector. We are stripping away all that heavy financial jargon and the dense data to give you a really clear, totally objective investment anatomy of the Manipal Hospital's IPO in today's explainer.
Okay, so let's just jump right into this. If you're wondering why the entire market is basically holding its breath for this listing, well, you just have to look at this one number. Rs 9,273.64 crore. That is the sheer, mind-boggling scale of this upcoming public market offering. We are looking at an absolute blockbuster of an issue here.
So here's our roadmap for the day. First, we'll cover the offer, then operational scale, followed by their acquisition strategy, the peer battlefield, and finally, proceeds and risks. Let's get to it.
Section 1. The Mega IPO Details.
Right off the bat, the investor quotas for this 100% book-built offer tell a very specific story about who is driving this train. 75% is reserved for qualified institutional buyers, 15% for high-net-worth individuals, and just 10% for the retail category. That heavy tilt toward QIBs? Yeah, that shows us this is primarily an institutionally driven play. The big money is definitely taking the front seat.
Digging into the vital stats, the issue price band is set between Rs 560 and Rs 590 per share. The company is backed by a real powerhouse promoter group. We're talking Dr. Ranjan Pai, MMG International, and Manipal Global Health Services. But here's the crucial takeaway. Post-IPO, the promoter's massive 81.43% stake is going to dilute as the company goes public and significantly expands its shareholder base.
Section 2. Operational Scale and Growth. Now, the company's financial trajectory is pretty undeniable. Revenue from operations climbs really steeply from roughly Rs 61,716 million in fiscal year 24 straight up to Rs 82,422 million in FY25 and blasting completely through to Rs 103,357 million in FY26. That is an aggressive, absolutely relentless growth curve over the span of just 3 fiscal years.
But what's actually driving all that revenue? Well, it's their physical scale. As of the recent filings, Manipal operates 10,761 beds across 38 hospitals. But here's the kicker. On a pro forma basis, which basically means incorporating their recent mega acquisitions as if they're already fully baked in, they actually boast an incredible footprint of 12,367 licensed beds across 48 hospitals.
Let's see how this physical footprint translates into actual profitability. If you've ever analyzed the hospitality sector, hospital economics are going to feel very familiar. The golden metric here is ARPOB, average revenue per occupied bed. It reflects the effectiveness of the hospital's pricing, their case mix, meaning are they performing complex, expensive cardiac surgeries or just basic care, and their service intensity. It's essentially how much revenue a single occupied bed generates in a single day.
For fiscal year 26, Manipal's ARPOB stands at Rs $68,937 per day. But, continuing that hotel analogy, a super high room rate doesn't really matter if the rooms are totally empty, right? Well, Manipal maintains a solid occupancy rate of 64.47%. And interacting directly with this is the ALOS, the average length of stay, which is at 2.78 days. Clinical efficiency means getting patients treated effectively and discharged safely, keeping that average length of stay tight so the bed can turn over to the next patient.
Section 3. The Acquisition Strategy.
The chronological momentum of their inorganic growth is honestly staggering. Check this out. In 2021, they scooped up Colombia, Asia, and VIKRAM hospitals. Fast forward to 2023, they added MRI hospitals to dominate the East. In 2024, they took over MEDICA Synergy. And most recently, stretching right into 2025, they acquired a massive near 90% stake in SAHYADRI hospitals to capture the West. So they aren't just building hospitals from the ground up, they are aggressively buying regional dominance across the map.
Section 4. Comparing the hospital giants.
So, this brings us to the critical question every institutional and retail investor is asking right now. How does Manipal stack up against the listed giants? To answer that, we really have to pivot from their internal metrics to external peer comparisons.
You see, Manipal is fighting a multi-front war for market dominance against some seriously established heavyweights. They're up against Apollo hospitals with their sprawling pan-India presence, Max Healthcare focusing intensely on the North and West, Narayana Hriday Alaya, and Fortis Healthcare. These are all established, multi-specialty behemoths, so the competition is incredibly fierce.
Let's look at the numbers completely objectively. Manipal's earnings per share stands at 7.71 with a return on net worth of 10.57%. Since their PE ratio will be determined post-listing, we can basically benchmark their expected valuations against Apollo's PE of 66.15, Max at 74.55, and Fortis at 70.22, alongside peers like Narayana Hrudayala. That peer group sets a very clear expectation for exactly how the market currently values premium, high-growth healthcare assets.
Now, let's do a direct face-off on that golden metric we discussed earlier, ARPOP. For FY26, Manipal is generating Rs. 68,937 per bed per day. Max Healthcare, however, is leading the pack right now at Rs. 77,800. What this shows us is that while Manipal is massive in sheer scale, Max currently holds the edge when it comes to premium pricing and a high acuity case mix.
But where Manipal truly shines in this prospectus is their top-line momentum. Looking at the compound annual growth rate for revenue from FY24 to FY26, Manipal clocked in at a staggering 29.41%. Apollo, which is their closest rival in terms of scale, came in at 19.24%. So Manipal is officially the fastest-growing hospital chain by revenue among the major players analyzed in this peer set. That's a huge selling point.
Section 5. Proceeds, debt, and risks.
So, out of the billions being raised, where is it all going? A massive Rs. 5,378 crore is earmarked strictly for the repayment or prepayment of borrowings. Another Rs. 574 crore is going directly toward acquiring a minority stake in their new step-down subsidiary, SAHYADRI Hospitals. The rest is just for general corporate purposes. The big takeaway here is that this IPO is heavily focused on cleaning up their balance sheet. And honestly, that debt cleanup is absolutely vital because, as the prospectus explicitly states in its risk factors, and I quote, "We will continue to incur significant expenditure in maintaining and growing our existing infrastructure, and we intend to incur additional debt in the future." The hospital business is just incredibly capital intensive, guys. Debt is simply a reality of this kind of growth model.
So we definitely must look at the risks objectively here. First, Manipal currently carries substantial outstanding debt, over Rs. 11,185 crores as of May 31st. Second, they face immense integration risks. Swallowing a giant network like Sahyadri Hospitals is no easy operational feat. It's like a giant puzzle. And third, some of these newly acquired subsidiaries are currently bleeding money. Sahyadri alone posted a net loss of Rs. 485.34 million in FY26.
Which really leaves us with the ultimate question. With this aggressive M&A growth and a massive anticipated valuation, will Manipal's clinical precision translate into long-term market dominance, or will the sheer weight of its recent integrations slow it down? It's a fascinating tension right at the heart of this mega IPO. I highly encourage you to dig into the prospectus yourselves and see where you stand. Thank you so much for joining me on this explainer, and keep learning.